A tip of the cap to you, and thank you for joining us here on the Pilot Money Guys podcast, where we're going to talk some aviation news and aim to bring you some lighthearted financial fun. I'm your host, wealth manager Robert Eklund, call sign Captain Rubber Mallet, and I am, of course, joined by certified financial planner Charlie the Godfather Mattingly. Welcome, Godfather.
All right, welcome, Rubber Mallet. You guys tried to get rid of me last time, but I'm back.
Welcome back. We missed you. It was like part of my. I had a limb missing or something. Charlie.
That's right. Yeah, me too. It was a good one though. Y'all did a good job with the professor and our special guest Gina Roth. She's very knowledgeable. So check that one out. What is that? What number was that, Rob? 50.
That was 52.
52. That's a good one.
Yes, sir. Yeah, we've had, matter of fact, we've had some huge podcasts lately. We had Dave Getch.
Yeah.
Dave Getch, the executive producer on The Big Bang Theory, and Kim Casey Campbell, whose book "In the Face of Flying in the Face of Fear" is now available to buy. Excellent. So if you haven't listened to those, go back and check those out, along with Gina Ross, number 52. So that's 50, 51, 52. Yep. Those are a lot of fun. Take a gander at them because they were chock full of advice.
That's
right.
I
think good advice. And a lot of fun, even if the subject may not interest you. However, today we're talking about a very important subject, the subject of giving. But before we dive into that, we're going to jump into some airline news. Charlie, yes. I know you had some stuff. Obviously, I want to talk about Delta.
Yeah. Oh, some stuff? What? I had stuff.
What do you got?
We talked about single pilot before on this, on our show, but that's an economic issue as well as a technology issue that's just going to take a long time to dope all that stuff out. So that's no surprise to us. Europe's aviation regulator has ruled out an industry push to allow planes to be crewed by just one pilot by 2030, but said it's considering allowing limited single person operation for parts of flights as early as 2027. But still, that's a pretty big hurdle.
Yeah, that is a big hurdle. That we're not there yet. One day it'll be there, and it'll probably come down, and eventually they'll go, unmanned, unwomaned aircraft there. But we're not there yet. There's a lot of infrastructure that has to go in before that happens. And everyone might think, well, the Air Force does it. If the statistics about how many airplanes the Air Force has lost because of unmanned vehicles gets out, a lot of people won't be flying those.
And the I guess the logistics might be the right word. It's very, very different. In the Air Force, you don't have thousands of airplanes in a small chunk of airspace in LaGuardia, JFK, Philly, and in DC. That's a whole different ball game.
Throw in an emergency or a thunderstorm or whatever.
And plus, like I said, when you're United and you've got airplanes ordered for another 15 years, they have two seats and they're set up for two people. So you'd have to re-engineer the entire airplane. That's a big deal for a company to do that. So that's some economic stuff there too. That's going to have to be fixed.
And I think the two pilot scenario here has led to a lot of increase in safety, records. So they better have the safety side on the house, which I don't think they do.
I talked
to one right now. It's so nice having two guys because there's inevitably something that you just kind of overlook or miss. As much as I hate to say that, it happens, right?
Yeah, I talked to one person that had been involved in, I think, getting an FAA certificate for an airline, and he just said the insurance companies right now, they just won't do it. They just won't insure, an airline with a single pilot or no pilot right now. So they've got to be on board with that too, because you can't fly airplanes without a lot of insurance, believe it or not.
Yeah. Well, speaking of that, we'll move right along. This is a topic that I'm super excited to talk about, which is Delta just approved their TA here, which is industry leading for sure. However, I kind of want to hit on how everyone's talking about it. It's huge amounts of money. The media says huge amounts of money, incredible pay raises. And I just want to harp on the fact, and I'm using what Delta was paid. A top end 12-year captain at Delta flying the 757 or the 767, the Boeing 757 or 767, was paid $296 an hour. And in 2023, adjusted for inflation, that would be the equivalent of $346.38 an hour, which all of that means that they really are getting a snap up of 18% pay raise. Inflation was 17.02% over that time frame. So they're really getting an actual take home pay raise of dollars they can use or buying power of 0.98% snap up. The next year it'll be 5%. Obviously, we don't know what inflation is going to do. Hopefully, it comes down, so that'll be an actual 5%. Maybe not a true 5% because we want inflation to be around 2%, or at least the Fed does. So maybe a 3% there. The next year's another 5%, and then I think it goes down to 4%. So we'll see there. I just want to harp on the fact that a lot of these contracts that are coming out are not as good as they sound in the media because of inflation. So Alaska actually negotiated, adjusted for inflation. I think I used 2020 numbers here. You guys can go back and check me, but Alaska actually negotiated a $1 an hour loss in their snap up pay rate because of inflation. Now, Alaska has some clauses in there. If the Big Four and JetBlue negotiate higher pay raises, I think they take an average. So hopefully that'll help them out. But very interesting how inflation affects your paycheck over the last 4 years. Obviously, hasn't affected that much previous 10 years. So.
Yeah, absolutely. And it's all about, to me, it's all about the economics of it all, Rob. It's like there's a supply and demand of the labor. And, pilots are in high demand and the supply is very low. And so that's, the pilot group has the leverage. And so they're going to be able to negotiate with a lot more negotiating power, as we're all seeing right now. And so that's economics. And I think if I'm flying an airplane as a passenger now, I'm pretty happy that they get paid well. I'm very happy too that my regional pilots are getting paid a little better.
Yes.
That was always a thing. Like, don't fly on the weekends on a regional because it's the guys and girls, But anyway, so that's different now too, because you talk about low pay for a long time. Remember starting in the regional world, you and I were military folks, but I know in regional world starting out, it was like 25,000, 35,000 back in 2008 and 9. You couldn't even make a living on it. They were working 2 jobs, but I think those days are behind us because of the.
I hope they are, and I hope the airlines realize that they're trying to increase the retirement age and lower the minimums and do different things to help their bottom line. But I think at some point, the safest thing, the right thing to do is just to pay them appropriately. And I was surprised that they were only, Delta is one of the highest paid, if not the highest paid workforce in the passenger carrying community, and they were only able to negotiate a 0.98% increase with all of the leverage maybe that perhaps the most bargaining power pilots have had in a long time. I just want that story to be heard, Charlie.
Inflation's crazy, isn't it?
It's crazy. It's crazy. Yep. Other news, questions from the flight deck. We got some good ones.
Oh,
Charlie.
man, I'm excited. I'm excited in this podcast because I get to talk some more. I was tired of listening to all these superstars and stuff, and just sitting there.
Who wants to hear Dave Getch?
That's right. Yeah, that's too funny. But no, I'm excited to go over a couple of these things, and I love. This one is from you, and maybe you're getting this one on. Maybe you actually are getting this one on the flight deck. I don't know, but your question was, are all annuities crap? And I think that's just perfectly. I love it.
I don't know if that was my question, but I like it.
I know, and I'm going to give you credit for it because it's just it's excellent. I think the answer is no, Rob. What do you think? You think it's
totally agree.
Yeah.
Totally agree. Yeah. No, they serve a purpose for sure.
Absolutely. And I think over time they've been oversold, and there's been high commissions attached with these things. And so that's been the difficulty is as a consumer discerning, well, is this good or is this crap? Because the salesperson's not going to help you out because they just want to make that sale. But those days are changing, and the insurance companies have done a good job of coming up with some products that actually we can use. And I say we as in people that don't make a commission off of annuities. There are times and circumstances where they make sense, and they've changed a lot. I mean, they've gotten a lot lower cost, Rob, and there's even a couple of products we'll talk about in a second, but man, I think there are, especially with interest rates going up. So in general, I'll just tell you, when interest rates go up, annuities are better. When you're older, annuities are better. And that's just because of the the tables, the life expectancy tables that they use for that. But Rob, I'll go into some specifics here in just a second. But what do you think? Anything on your mind about annuities that are such an exciting topic that we love?
Yeah, I think you hit the nail on the head. They used to be, more of a pariah in the eyes of most fiduciary financial advisors because of the fees and everything that were associated with them. But however, they've been changing, and now they're a lot more useful. And we use them. We've talked about this on previous podcasts. During for your minimum dignity floor type scenario, if you don't have enough pension or other secured income, annuity is a great product to secure some of that income, not for perhaps everything, depends on your plan. Obviously, we're not giving you advice because we don't know you, but for those that we do know, it can make sense to cover some of those fixed type assets, and it decreases your risk, obviously, because you're going to get that, and there's a bottom floor to it, which is helpful, perhaps, depending on your plan again, during sequence of return risk and some of those things. So
yeah, that's right. Podcast 45, we talked about that sequence of return risk, and that's and annuities can help with that. And I'll just to be clear, I think like you're a good example, Rob. I mean, you and Jana are going to have 3 annuities. You're going to have your Air Force pension. You're going to have each of you are going to have Social Security. So you probably won't need another one. But there are some people out there that don't have that, and they're looking to create their own pension, if you will. And I'll just say that, and I'm giving you credit for all these notes here because
good.
Maybe
Yes.
you wrote them. But anyway, it says people that hate annuities compare them to investments. Life insurance, and for example, an annuity is more like life insurance used when people pass away early. You're insuring a risk, and annuities are kind of the opposite. They're insuring the risk of living too long. And so that is something that is significant now. People are living longer, and we need to make sure we address that risk. But that's kind of the big picture of it. And I'll go into the details here just for a second before everybody falls asleep in too much annuity stuff. But, the simplest of all the annuities is called the single premium immediate annuity, or SPIA, as the nerds in our industry like to call it. And that's simply where you just write a check, $500,000 or so, to the insurance company, and your money is gone. And then for the rest of your life, they're going to give you a stream of income that's guaranteed until you die. Now, most people don't do that, Rob, because they don't like writing a check. They don't like losing that principal. And so there are other things out there called fixed indexed annuities. Those have a little bit more flexibility. And then variable annuities and everything in between. I mean, there's hundreds out there, lots of moving parts. That's one of the most difficult things about annuities, is knowing actually what you're buying. And sometimes the salesperson doesn't even know what they're selling. They're very complicated, moving parts. But
they're confident. They're confident in what they sell. That's for sure.
So just be careful, and do some homework. But anyway, one of those that I want to highlight today before we move off this topic is there's another one that's very interesting, Rob, that's got our attention, and we call that, I think the official name is contingent deferred annuity. And we work with a company called Retire One, and for some reason, Rob, they call it Constance. I guess maybe it's a constant income or something. I don't know, but I'm like, Constance, that's just a weird name. Change the name. So it's kind of interesting, Rob, because you can take any account, an IRA. I say any, actually, it is not a 401k. It's got to be an IRA, Roth or non-Roth, or a taxable brokerage account. And so then you essentially wrap this account in this Constance or contingent deferred annuity. You wrap it, and that means you pay a little extra and you get a guaranteed stream of income from that, and nothing else changes. Like, you don't actually move the money somewhere. It stays right where it's at. Most of the time it can be invested exactly like it is. And so that's very different. And it's very different because I can turn it on, I can turn it off. If I get through, like you and I talked about the sequence of return risk, right? Early on in that retirement, I've heard it called, 5 years before retirement, 5 years after, that 10-year window, whatever. But once you get through that, risky time period for retirement, you could turn the thing off. There's no fee to exit the annuity, and which is awesome. It gives me some ultimate flexibility. I still get to invest in mutual funds, ETFs, whatever I want to do, but it gives me that floor that's guaranteed forever, regardless of what happens to that account. And so that's comforting to people to know that they're going to have that amount of money coming to them no matter what happens. That minimum amount of money will always be there for them, even if the account goes down to zero. So there's a real comfort level there, and there's some insurance, and we're insuring against that risk. So that's very interesting to me. That's one of the most interesting developments lately that has caught our attention.
Oh, I love it. I think you hit the highlights there. Should we go to bonds? You ready? You want to hit more on annuities?
Oh man, I'm excited about bonds. So let's go there.
Yeah. Should I own bonds?
Yeah. That's
Charlie?
A lie. Anybody that heard me say that that I just lied. I'm never excited about bonds, but they are more exciting now than they've been because, well, interest rates are up. And like I said, when interest rates go up, they help retirees, quite honestly. And there's more options for annuities, for bonds, for short term. You and I have talked about I bonds and treasury bills. So there's some interest out there. You know what I mean? If people have cash sitting around, then there's no excuses anymore to not get that cash working for you.
There's not. Oh,
so, one of the things that we get asked about, Rob, is should I own bonds? And really we're getting asked this more now than before because they're more interesting and
they're sexier now.
Hey, wait a second now. Yeah, bonds are sexy again. Well, there's two reasons we think you should own bonds, and it could be one or both or neither. And one of them is for your portfolio. Let's say your long-term investment strategy, retirement for like me and you, Rob. We may choose to own bonds because it dampens some of the volatility in our portfolio. And let me explain that a little bit more. Last year was really a rare year, unprecedented really, in that bonds were down so much. But typically, and again, let's go back to our pre-retiree of 5 years until they're retired. Typically, you like bonds in there because they're going to be the ballast in the boat, some people say. When the market tanks, like it did in 2008, typically, not always, bonds are going to hold up fairly well. And they might even go up a little bit. And the reason that is because especially treasury bonds tend to be a flight to safety. When people get nervous, they want to put their money somewhere. One of the most trusted places in the world is U.S. Treasury bonds. And people will scoff and laugh maybe as I say that, because the U.S. is, we have our own problems, but relatively speaking across the world, it's a safe place to be. So that when people run to those investments, Rob, it causes the prices to go up. And so that kind of helps your portfolio a little bit, right? And so what that also does is it reduces the time frame that my portfolio has to recover.
Yes.
And that's just simple math. And so that's one of the reasons why we want to own bonds in our portfolio, is to reduce that recovery period, especially if we're close to retirement, because I can't afford a 10-year recovery period if I'm really aggressive. What do you think, Rob?
Yeah, I think it's you're hitting all the high points there. It's important to note that if you're a younger investor or if you have time on your side, again, we have higher expected returns for more equities or stocks. Yeah. So we're not saying you have to own bonds or you should own bonds. Again, we don't know your situation, and we're not giving advice. But if we're out there and you're a young investor, you don't necessarily need to own bonds because we do expect a higher return in equities if you're getting older or you can't stomach, right? Yeah. There's a reason why the stock market returns a high percentage, maybe 10%, and the average investor returns a lot less than that because they can't stomach the volatility that you spoke about, Charlie. So right. The bonds are there for the ballast to help you weather those volatile periods and not basically help you not make a big mistake on selling and getting out of equities that are going to eventually come back for you if you have time. If you don't have time, obviously bonds are a lot better there. Also, I like it, Charlie, we talk about bonds for the folks who don't like that volatility. They help you during the rebalance and have a little bit of dryish powder, if you will, to rebalance when your stocks go low. You have a little bit of funds there if your bonds don't tank like they did in 2022. But back in 2008 2009, you had some dry powder you could then leverage into stocks and buy stocks lower which
Yeah.
I always like too. But again, foot stomp, we still expect for a long-term investor, we still expect a higher equity exposure or stock exposure will outperform a 60-40. However, your point that it helps you recover faster is very critical for our folks getting close to retirement. The 2000 to 2009 crisis. If you're a 60-40 portfolio, you recovered so much faster than obviously if you're 100-0. So
yeah, I'm going to show that graphic in a second. I'll share my screen because we typically use this a lot when we're talking to our own clients about risk and how much should we take. And I'll show this in just a second. But really, it's a math problem, Rob, because I'm going to give you a quiz, right? If you have $100,000 and we have a 50% decline in our portfolio, what return do I need to get back even?
Right, you need 100%
100%.
return.
Yeah, and so now that's not linear. It's not always 100%. Like for example, if I have a $100,000 portfolio, I lose 25%. I need a 33% gain to get back. So that's another example. In fact, check out our show notes. I've got a link to a website where you can put in any number, any combination you want, and it'll show you how much return you need to get back to even. So, so it's a math problem. So we just don't want near retirees to have 100% gain to recover. It's just going to take too long. And so let me share my screen with you real quick, because this is for those that are watching on YouTube, possibly. I want to illustrate the point that you talked about, because it is a great point. Because people say, well, why don't I just own why don't I just own more bonds then if I'm a younger investor? And that is because of what you just said, Rob. If you've got the time, then, and this chart shows this very well, what we're looking at here is 100% stock S&P 500 portfolio in 2008. It went down over a little over a year period, probably close to 50%, not quite 12 months, but more like 14 months, from November of 07 or October of 07 till I think it was maybe late February, March of 09. But if you were 100% equity S&P 500, this chart shows you got back to even in March of 2012. So that's 5 years. And that was a long, painful 5 years for those of us that were 100% equity. It was very difficult. For those folks that were 60-40 and had some discipline and they stayed with it, they were back to even 2010, October of 2010. So that's quite a bit earlier, 2 year faster, and even faster if you're 40 stock, 60 bond. This is again just 2008 looking back. You were recovered by November 2009. So you can see those recovery periods. Now, I was a young guy then, Rob. You were even younger, so I didn't care about.
Yes, I was.
You were a lot younger than me, more handsome, better shape.
I wouldn't go that far.
Anyway, yeah. But the interesting thing is, for those that, I'll try to describe this for those that can't see this, is that once you got around 2016, 2017, 2018, that 100% stock portfolio really started to take off and differentiate itself and give higher value. So that's why, as a young investor, you may not need as much bonds, but that's kind of what you were talking about. And it's funny how we state the obvious. If you're a young investor, you don't need as much bonds. If you're an older one, you might. But this is why. It's kind of math. And so I think it's fascinating, and hopefully that's helpful to people thinking about, where they should be in their risk tolerance and asset allocation.
The other point to throw in here, Charlie, is we talk about risk and how someone's going to be treating their portfolio because of their risk. Mm-hmm. And that risk is going to change based on the time horizon for that specific portfolio. You might have, the bucket strategy, too many buckets in advising, but one of the bucket strategies, some of your portfolio may need bonds, but some of your portfolio, even when you're retired, may not need bonds. Yeah. So that's where it really helps to think these things through and talk to somebody who knows what they're doing.
Yeah. Yeah. Even the day you retire, you're age 65, you still have to be a long-term investor, because like you talked about earlier with inflation's going to eat your lunch if you're not, doing what you can to keep up with it, at least keep up with it, hopefully outpace it a little bit. But that's the first reason, we own bonds because of our portfolio. And that really hasn't changed. Even when bonds didn't have any yield or any interest, we still needed to own them for that reason, which was difficult. It's even a little easier now. But the other reason you might want to own bonds is exactly what you just said. When you're in retirement, you can have a bucket strategy. Let's call it bucket 1 or 2, where you've got some short-term bonds, T-bills that we just talked about, maybe annuities, and they're going to pay you 5% at this time. We don't know how long that's going to last. It depends on a lot of things, but annuities are interesting. We talked about those a few minutes ago. A great part of a potential bucket strategy, and some of those you can get 6-ish%, depending on, maybe even higher if you're older, depending on what type of annuity that is. So those are some good things and some other reasons why you may own bonds. And they're sexy again, Rob. I got a little excited there about bonds, which is unprecedented because
it's been years since that's happened.
Right. That's right. Absolutely. Yeah.
All right. Well, speaking of helping you out, if you need help managing your investments, whether it be for retirement or that Corvette you've been dreaming about, give a fiduciary fee-only advisor a call. These folks stand ready to help you. Here at Leading Edge Financial Planning, we are fiduciaries. I can't even say that. That's a tough word to say. Meaning we do what's best for you, not Wall Street brokerage companies. We're fee only, which means we only get paid by you. When you do well, we do well, and vice versa. So if you feel so inclined, give us a call, 865-240-2292, or hit us up on that old electronic mail at info@leadingedgeplanning.com to sign up for our newsletter, which, Charlie, kudos to you, was fantastic. This last one I just read was fantastic, by the way. Nice work, Godfather.
Thank you. Yeah, I took a couple of months off of the newsletter. We're transitioning to get some more help. We use a company called Nifty just to help us out with some of these administrative things. And so we're busy, Rob. We're busy. Tax season, man, and all this stuff. So we're getting back in the groove.
Do we get some of those orange slices over to Kevin and Betsy?
The orange slices is fantastic. I got to tell on you, Rob. Rob is such a thoughtful dude. He's like, man, our tax team is really just working hard, and they're in the tax cave, as we call it. We're trying to pick up the slack and do paperwork. One of my clients the other day was like, dude, my paperwork had the wrong name, the wrong birthday. It was in the wrong blah. And I was like, well, sorry about that. That was me. That's what happens when I do paperwork. But anyway, I figured he would forgive me a little bit. But you had the great idea of providing our tax team with orange slices. Man, that's very thoughtful.
It's a marathon.
Very thoughtful. I haven't done that yet. I haven't figured out how to do that exactly, but anyway, we'll get them some orange slices or something.
We'll figure it out.
Yeah. Good.
Awesome.
Good.
All right. Break. Let's jump into how to give, Charlie. And I'm going to kick this off by reading, of course, any chance I get to read one of Warren Buffett's letters to shareholders, I'm going to do it. This one was on February 25th, 2023, but it's talking about giving in a roundabout way. And this is: a common belief is that people choose to save when young, expecting thereby to maintain their living standards after retirement. Any assets that remain at death, this theory says, will usually be left to their families or possibly to friends and philanthropy. Our experience, again, this is Warren Buffett. I don't have a good voice as he does, but our experience has differed. We believe Berkshire's individual holders largely to be of the once a saver, always a saver variety. Though these people live well, they eventually dispense most of their funds to philanthropic organizations. These in turn redistribute the funds by expenditures intended to improve the lives of a great many people who are unrelated to the original benefactor. Sometimes the results have been spectacular. The disposition of money unmasks humans. That could be a quote right there by itself. Charlie Munger is who he's talking about there. Charlie and I watch with, not Charlie Mattingly, Charlie Munger and I, Warren Buffett, watch with pleasure the vast flow of Berkshire generated funds to public needs, and alongside the infrequency with which our shareholders opt for look at me assets and dynasty building. I thought that was fantastic and really interesting on how obviously a different side of what most people are like, how they live and how they think about obviously Berkshire being super successful. Charlie, I don't know.
I love it. That actually was me, Rob. That was me and Warren there. But anyway, other than that, it was pretty good. Good job. But no, that's, I think we'll start with that. We're going to get into some nuts and bolts real quick. And then we're going to end with a little bit more touchy-feely, as you and I like to say, because I think giving there's a secret power there that we'll talk about in just a second. But let me throw out some information. Since it's tax season, in honor of our tax team, Kevin, the professor, Nadee, yet to be named, Grover, tax specialist, and Betsy Barracuda Wheeler.
Barracuda.
Barracuda. Yeah, that's it. How does that sound? We're gonna.
That's good.
Just trying that out. She was a swimmer.
It.
She was a swimmer in college. So, but anyway, they're kicking it on the tax team. So in honor of them, I'm going to go into the tax weeds just for a second. So hang tight. The most important thing, or one of the most important things when giving, is just to think about, well, I shouldn't say that. That's wrong, right? Most important thing is tax deduction. No, that's not true. The most important thing about giving is giving with a good heart, blah, 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 all that stuff. But anyway, let's talk about taxes. So if you give, let's just use a $5,000 a year example, Rob.
Yeah.
I'm probably not going to get a tax deduction for that unless my other deductions are pretty high. Right. And so right now, I think we have about a $27,000 standard deduction. Boy, I should know that a little bit better. I might have to look that up.
I thought that was high, but I got it. I'm going to get it right now.
Get it for me. Yeah, it goes up a little bit every year. But so let's pretend that it's 27.
You were low, 27,700.
27,700. So let's pretend for a second that you give away $5,000, and that between state, local taxes, you get a $10,000 cap there. So we're at $15,000, right? I get $10,000 deduction for my state and local taxes, $5,000 deduction for my giving, and let's say I have another $5,000 of mortgage interest. If my second grade math is correct, that's about $20,000, right? Yep. That is less than the $27,700 standard deduction. So I essentially get no tax deduction for my giving. Okay. Again, like we said, that's not the primary reason we give, right? We have a happy heart and all that stuff.
Yes.
But just know that you're not getting a tax deduction. Now, the reason we say that is because there's this idea called lumping of your giving, lump the giving together, bunching, lumping, whatever we want to use there. But
yes,
maybe instead of giving $5,000 one year, I give $10,000 the next year. I skip a year. And that way, my math really still doesn't work very well in this example. But the point is you might exceed that $27,700 standard deduction, and you might get some deduction, some credit for your giving. And so that's the important thing is you got to outgive that standard deduction of $27,700 before any of your giving is tax deductible. So hopefully that makes sense.
No, it does. And we've kind of talked about this and wondered what your thoughts are on this. But as long as it's a qualified charity that, is recognized by the IRS and the tax gods that are around, you can go ahead and give that lump sum during those years, which is why if you're, say you're going to church and you're given in the plate that comes around, you're probably not going to be able to deduct that. Not while you do it, but if you're able to lump sum and they're a qualified tax charity there and one of the organizations that you can give to and have that tax deduction, then perhaps you can give, say you had a lump sum of 30,000, Charlie, then you could give all of that in 1 year and perhaps go over that standard deduction and be able to deduct more on your taxes. I think that's pretty key.
Yep, absolutely. That's the point there, is just to understand when you're getting a deduction for that giving and when you're not, and that applies to basically any deduction, because the standard deduction a couple of years ago went up pretty significantly. So you're going to get the deduction, the standard deduction, or your itemized, whichever is higher.
Yeah.
So, but the other things to think about, that kind of bleeds into what you and I talked about earlier, the donor advised fund.
Donor advised funds rising in popularity. They've come I guess they're just huge at Vanguard, Fidelity, and Schwab right now.
Yeah, absolutely. So we use these occasionally. Basically what it is, let me start with that, is it's just an account that you establish. There's an application process like any IRA or anything like that, but you open this account, donor advised fund, and then you can transfer cash in there just like you would contribute to any account, or you can transfer stock in there. let's say you have some highly appreciated stock. Talk to somebody today. They've had Exxon for 30 years. So they're going to pay some taxes on that when they go to sell it. They're going to pay some, quite a bit of taxes. But what they could do if they wanted to is transfer it into a donor advised fund. It would be a tax deductible thing. They would get a deduction for the fair market value of that stock when they transferred it into the donor advised fund. And let's say they just didn't know who to give it to at this very moment. They could transfer $100,000 of stock into that donor advised fund. They could get a $100,000 deduction as long as it wasn't more than 30% of their adjusted gross income. That's the rule. That's for a stock. For cash, it's like 60%, I believe. And so they could get that deduction right then, that year. So that's important because you might have a year where you've got especially high income for whatever reason. You just happen to want to donate something. Well, that's the way to do it. And then you can kind of sparse that money out or give that money out to whatever charity you want over the next several years, or not at all. You can wait for the end of your life, etc. A lot of flexibility there, Rob.
Yeah. And so just so I'm clear on this, so if I make $1 million a year, I don't, but if I did make $1 million a year, I can, and my Exxon stock went up to 300,000 from whatever I invested, say 100,000. There's that $200,000 I would normally pay taxes on if I'm going to take it out. But if I give it to my church or whatever tax exempt organization there, they can realize all $300,000 of that. Now, do you need a donor advised fund to do that?
The answer is no. Thank you.
Yeah. So you don't need a donor advised fund to give that money there. You can still take the tax benefits without the donor advised fund. And the donor advised fund comes with some good things. One, if it's cheaper than setting up a foundation or a trust or any kind of charity like that, it's much faster. It's very easy, like you mentioned, very easy to set it up. You just apply just like an IRA or anything like that. You can name it. You can name it. The Duke Eklund. That's my
Rubber Mallet Foundation.
The Rubber Mallet Foundation. And when you can give anonymously, or you can give via that charity, which is kind of cool. If you're thinking of family wealth and passing down knowledge through the generations, it's a way you can perhaps roll in the grandkids or your kids into thinking about charitable giving and help them. They can maybe help with the donor advised funds. Now, again, you could probably do this without the donor advised funds, which the donor advised funds have some limitations. And that's just the administrative fee. If you're going to invest in any kind of investment, ETF, mutual fund, they have expense ratios in addition to those. So keep that in mind again. But of Fidelity, Vanguard, and Schwab, Vanguard has higher minimums you have to put in. I think it's 20,000. You can go on the website and check it out, and they might have changed it, but pretty high. You have to at least contribute 20,000 to a donor advised fund, and then minimums of, I think, 5,000 or something like that. Whereas Fidelity and Schwab are much lower. You can get a donor advised fund for a lot less than that, but it gives you the flexibility. You get the donor advised fund, you have stock, you have mutual funds. I think you can have Bitcoin, crypto, real estate. I don't know what else. You can put almost any appreciated asset in there. Which is pretty cool if you want to maybe donate those types of things, and that's a way you could do it.
Yeah, those are great points, and we've got a good link to a Morningstar.com article about donor advised funds, kind of the pros and cons, and just what you said. There's some administrative expenses there, but it gives you some flexibility. So I think has to be a very specific situation where you may not know what you want to give to right away, but you really want that tax deduction and so on and so forth. Because the other giving strategy is giving highly appreciated stock. And that's in our Exxon example. Let's say we got $300,000 of highly appreciated Exxon stock, and I know exactly that I want to give it to St. Jude or local church or local charity or whatever. Then I can give that stock directly to them and kind of get the same benefit. In fact, there's one strategy that I think is pretty interesting in that if you have, let's say, again, highly appreciated Exxon stock, and you love the stock, but you also love to give. Maybe the strategy is that you give away your low basis stock In other words, the basis is how much you paid for it. So if you bought it 30 years ago, let's say you paid $10 for it. Now it's worth the price is $200 a share, whatever it is. I don't even know today. Well, that's going to be a lot of taxes. So take those particular shares, donate them to your charity that you like to donate to anyway. Then you can repurchase the Exxon stock with the money that you would have donated, the cash that you would have donated. And now you've just reset your basis there, still own the same amount of stock, but you've reset your basis and you've saved yourself a ton of taxes. So that's one thing to think about there.
And it's something to think about. How much do you want to give? Are you going to give the same amount regardless of how much that stock appreciates? One of the key points that a donor advised fund can help with is keeping track of your taxes. So if you donate all these different, if you donate to 20 or 30 different charities, that can be tough to keep track of, right? And you're like, oh, I donated to so-and-so and this, that, and the other. It's hard to keep track of for tax purposes. The nice thing about donor advised fund, you just drop that $30,000 check, boom, into the donor advised fund. It's recorded. You've got it. You don't have to keep track of anything else. It'll go to those charities and you don't have to deal with it. So that is a nice deal. The other last thing I'll say about donor advised funds is you can end up, I think there is a benefit of donating to international charities and getting some tax benefits on that. But
nice.
That's it.
Yeah. One of the last nuggets I'll throw out there, it's a thought experiment. Rob, are you ready? So we like to stick it to the man being the tax man, right? I'm talking about the tax man.
IRS.
And so when I give, if I'm let's say I'm in the 32% marginal tax bracket, let's just pretend for a second. And I give $10,000 to my favorite charity. Guess what? I'm actually giving about $6,800, and the government, the man, Uncle Sam, is giving the other $3,200.
Yeah.
So what do you think about that? What do you
think?
I
love it. Yes.
That's right. Stick it to the man.
Yeah.
But
make them pay some of it.
That's right. Last thing I'll say is, there's the softer side of this giving thing that you and I, we always like to get the touchy feely stuff, right? So I looked a little bit on psychologytoday.com. Dr. Eva Ritvo, she wrote this thing about giving, and here's what she says. She says, neuroscience has demonstrated that giving is a powerful pathway for creating more personal joy and improving overall health. Dopamine, serotonin, and oxytocin make up the happiness trifecta. Benefits are better mood, sleep, digestion, memory, learning, and appetite. Blood pressure decreases. Oxytocin is known as the cuddle hormone. So Rob, if you need more cuddling, then make Jana give you some money, right?
Yes.
It says trust and empathy are enhanced. Oxytocin is also anti-inflammatory and reduces pain and enhances wound healing. So if giving allows us to secrete all these chemicals at once, we owe it to ourselves to give as often as possible.
I believe it. The more you give, the more you get. That's just the way the world works, at least from my opinion.
That's right. I just tell my wife, I just give advice. That's all.
Yeah.
She's like, thank you very much.
She's like, yeah, you get no oxytocin.
No cuddles for you.
No oxytocin. Like it. All right. I love it. That's all I got, Charlie. Mm-hmm. Okay. We'll leave you with a couple of quotes for your drive home or your honeydew chores or whatever you're doing there. This one's from Regis Murray. Part of being a person is about helping others. And the next one's from Robert South. If there be any truer measure of a man than by what he does, it must be by what he gives. And that's it. If you want to help people become more financially literate, which will help their eventual income in retirement, hit the subscribe button and drop a review to help us reach more people. Remember, as Emerson said, the world makes way for those who know where they are going. And as I say, so plan accordingly. From all of us at the Pilot Money Guys, we wish you smooth rides and soft landings. Thanks, Godfather.
All right. Thank you, sir.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only. It does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from these projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.